Hello, everyone, and welcome to another episode of the WTFinance podcast. On this week's episode, we're happy to be hosting Brian Feroldi. So Brian started investing in 2004 while working in the health tech industry. And in 2015, Brian became a writer for the Motley Fool. So he's since written more than 3,000 articles on stocks, investing, and personal finance. After being kicked in the teeth a few times in his early investment career, his returns improved dramatically over his time as experience and knowledge about the stock market grew. Brian is also releasing a book in April 2022 titled Why Does the Stock Market Go Up? Everything you should have been taught about investing in school, but weren't. So I think that's available for pre-order now on Amazon. So go check that out. So Brian, thank you for joining the podcast. And just on to my first question, sort of why did you keep investing despite those early setbacks?
Yeah, great question, Anthony. Thanks so much for having me. Yeah, data actually shows that what happens to you when you first start investing and what happens to the stock market in your most formidable years can actually play a huge role in your view of the stock market for the rest of your life. And I use the air quotes when I talk about investing in 2004, because at the time I had no idea what I was doing. I had only read a few books about investing at the time. And my investing strategy was to buy penny stocks and try and flip them within a matter of days or weeks for higher than I sold them for. So that's why my strategy failed miserably, is because I was investing the complete wrong way. I just had no idea what I was doing. However, I kept going because I had read enough books at that point to understand that the basic concepts of wealth building. So anybody can be rich. Building wealth is your responsibility. It's not anybody else's responsibility. Continuous savings and putting money into things that appreciate over time is the best way for most people to do that. So I had those core concepts down, and my whole life I've just been a natural saver. Like I've always just had an affinity for saving capital. So I think I learned early on that my strategy wasn't working of buying and selling crappy penny stocks. However, I'm pretty sure that I believed in the long-term power of wealth creation, and I still really, really desired to become wealthy enough to become financially independent. So that's why I kept going, despite the fact that I made so many mistakes.
And that seems like a constant thing. I know for myself, like when you're younger, you just want to make money as quickly as possible. So you try these crazy investing or trading techniques, and most of the time we find they don't work.
Yeah, the hard way, unfortunately. So I learned so many lessons the hard way. And I guarantee you, if I was starting out today, I would be doing the exact same thing that so many other people was doing. I would be on Reddit forums. I would be trying to find the next meme stock. I would be doing as little research as possible. I would be on Robinhood. So everything that people are doing today, that would be me if I was starting today, for sure.
Yeah, and I think the lucky thing is most of the time when you're young, you don't have as much money to lose. So that's the benefit. You take these lessons, but you don't actually get the massive downside that a lot of people experience.
Yeah, I only lost a few $100, maybe a few $1,000 with those early mistakes. However, at the time, that was a lot of money for me, and I still have mental scars from those losses, even though in absolute terms they're not that high. But so the lessons that I learned, I consider those losses to be essentially the tuition that I paid to learn about how to invest the right way.
Yeah, and it's a lot cheaper than university or college fees.
Yeah.
we all have to pay for and you know, these experiences, they led you to create your own investing framework, which is called the Feroldi Quality Score, which anyone who's watched one of your YouTube videos has definitely seen, and they understand how it works. But you know, how did you create this framework?
So I joined. I was buying and selling stocks since 2004. After a few years, I got turned on to the Motley Fool. If you're familiar with them at all, they produce dozens of free articles every day where they talk about stocks, and they do some very basic stock analysis for free. I was reading those things like crazy, and then I finally became a paying member to one of their services in 2008, 2009 time period. And if you join up to be a Motley Fool member, you start paying attention to the markets at all, you quickly realize that there are more ideas for your capital than there are potential uses of your capital. And in the beginning, I would read a buy report on a stock, and I would just do some quick mental math in my head to be like, does this fit my investing style, my investing strategy? And I would basically say, yeah, this one fits the most of it. I'll buy that. This one doesn't. I'll skip buying that. But I didn't have a process in place. And over time, the number of recommendations that were coming my way, and the number of good stock ideas just overwhelmed what my brain could handle. Finally, I got smart enough to say, maybe I should write this down so that I outsource the thinking and the memorizing from my brain to something that I can iterate on. And what I did was something I recommend to everybody that's listening to this, especially if you are an individual stock picker. Start by making a list of all of the business attributes that you find appealing, right? Think about the financials, think about the moat, think about the company's opportunity, think about the management team, think about the stock performance. You can even throw in whatever technical indicators or anything like that that you like. But whatever it is, make a list of all the things that you would say, if this company had this, I would be attracted to it. Then make another list of the exact opposite of that. Make a list of all the things that you don't want to see in a company. So for me, that's things like customer concentration. I don't like extreme levels of stock-based compensation. I don't like it when the company is in a declining industry or it's under threat of being disrupted in the near term. I don't like it when the stock has dramatically underperformed the market since coming public, et cetera. So you make your two lists. And then you rank them in order. Force yourself to rank the attributes in order from most appealing to least appealing. Same on the unappealing side. Then give yourself 100 points to assign to the metrics that you find most appealing, and then subtract some points to the metrics that you find unappealing. Then that's exactly what I did and exactly my process. So what this allows me to do is whenever I come across a stock that I'm interested in researching, I can go from my checklist top to bottom in a matter of an hour or two. And that gives me a really, really good idea if this stock is compelling enough or meets the vast majority of my criteria so that I would consider putting it in my portfolio. And conversely, if a stock is just a dud and does not, I can essentially dismiss it forever. But by writing things down, I finally came up with a way to compare stocks and opportunities against each other according to the criteria that I set. And I've just been doing that now for about 5 years. And as you point out, I kind of do this on my YouTube channel, and I made my checklist freely downloadable so that anybody can do this process on their own. But I just can't tell you how useful it is to write down these things and then consistently follow a process. It'll just dramatically simplify investing for you.
Yeah, and I know I do the opposite. We do it in our brain, but then there's just that possibility of forgetting things or just, getting into the FOMO, all these small things that could happen that could really impact your returns.
Yeah. I forget who said it, but it's so true. It's your brain is for having ideas. Your brain isn't for remembering ideas. So it's amazing how checklists, investing journals, watch lists, these tools are free. They're available to every investor, and they're just so incredibly useful. And in my experience, especially amongst new investors, they're just incredibly underutilized.
Yeah, definitely. I think that's great advice. Just try and create your own framework on what's important to you. So, you mentioned a few things there: moats, ownership, all these management, all these different things. Sort of, what was your influence for many of these thoughts and many of these ways that you analyze stocks? And has that changed maybe over your investing career?
Oh, it has changed dramatically. So I, like many people, started by studying the greats, Peter Lynch, Warren Buffett, Charles Aker, David Gardner, Tom Gardner, Bill Mann, etc., Jeff Fisher. I just made a huge list of the investors who I admired. And then through a little bit of research, I found out what criteria appeals the most to them. And many of them, many investors freely put their investing criteria out on the web for you to research. So I didn't start blind when I was creating my checklist. I kind of picked out the investors that I most admire, found out what criteria matters to them, and I included that in my checklist of positive attributes. And then again, the forcing ranking of the order of those things is just such a powerful exercise to do, because Warren Buffett and David Gardner invest completely differently from each other. One is 100% focused on, Warren Buffett's focused on, it has to be a low valuation, discount to intrinsic value, and it has to have a wide and enduring moat. And the other investor is, I invest in disruption and I don't even look at valuation. And both of those strategies have been very, very successful over long periods of time. But you just have to ask yourself, what kind of investor are you? Are you the investor that really focuses on cheap valuations and dividends? Or are you the type of investors that's swinging for the fences and is willing to strike out a whole bunch? So I am more on the swing for the fences than I am on the valuation side. But that is something that I've learned about myself over time. The way that I approach investing has changed dramatically over the last 15 years. And I would say it shifted gradually away from Warren Buffett, hyper-focus on valuation, towards David Gardner, hyper-focus on business quality and long-term potential. But that's just something I've discovered about myself from studying the markets and making mistakes.
And do you think that may be linked to sort of the market? If we look over the past 12 years, maybe once you joined, or even 14 years, once you joined the Motley Fool, it's been very beneficial for people investing in growth stocks. So do you think that's had a major influence as well, maybe on your investment decisions?
Oh, for sure. That firsthand experience, of course, shapes the things that I do, and that is a very fascinating question to ask. Is the checklist that I'm using today biased in some way based on what has happened in the market over the last 14 years? That is a very real risk that I could be overlooking. However, I'm still the way that I would counterbalance that is by looking at some of the greatest growth stocks of the 2010s. Right, the 2010s. You would have made incredible amounts of money buying Amazon, buying Netflix, buying Activision, buying Monster Beverage, etc. And from 2000 to 2010, or when those companies came public, the returns that you would have earned were enormous. And that's despite the fact that from 2000 to 2010 was the lost decade for stocks, right? It featured two market crashes. And if you were just investing in broad-based index funds, your wealth essentially went nowhere in real terms during that time. But yet, if you bought highly disruptive, high growth companies and held them early on, while you had to deal with an insane amount of volatility along the way, the long-term returns were very pleasing. But it would also be foolish of me to say that the criteria that I'm using today and the thoughts that I have about the market right now are going to persist forever. I know that my style has changed a lot over the last 15 years, and it would be inconsistent for me to say it's not going to change again over the next 10 or 15.
Yeah, definitely. And then, three key parts of your analysis that really jumped out at me when I've looked at it. And I think they were probably the first three that you mentioned when I asked about your quality score. So it was like the moat, financials, management. So I guess, how would you define each of them? What importance do you place on them individually?
Yeah, so the exact score I place on each of them, the metrics that I placed on each of them, you can check out on my score. But if you were to ask me what are the three most important things that I look at, the number one would be the moat, which is the company's competitive advantage. If you don't have a competitive advantage, capitalism is pretty brutal, and it will assure that if other companies see what you're doing and you're making money, they will come in and try and steal your customers and try and copy what you are doing. So you better have something in place that prevents that from happening. And that definitely came from Buffett, right? That's that Buffett influence thing that pretty much every investor adopts along the way. The second thing that I look for, the thing that scores the second most on my checklist, is a much harder thing to account for, and that is optionality. And that is when a business has the ability to create new products or new services that open up new market opportunities and can drive continued revenue growth over time. Most famous example of that of the last 20 years would be Amazon Web Services, right? In 2005, if you bought Amazon stock, you were buying just an e-commerce company, right? Just Amazon and the retail business. Well, within a few years, they rolled out Amazon Web Services, and they had all this extreme compute power that they were using internally, and they decided, well, let's make this external, rent it out to companies, and we'll make money off of that. That is a great sign of optionality. So in early 2000s, when you bought Amazon, you had no clue that they were about to launch this other product within their existing wheelhouse that would drive tremendous revenue and profit growth over time. So that is something that's really hard to account for, but I do think there are some clues that you can look at in a company's own history to tell whether it has optionality or not. And one simple one is just by looking at the company's own corporate history. If the company has a history of experimenting, spending on R&D, and successfully rolling out new products and services, the odds are pretty good that it will be able to do so again and again over time. And if you look at some of the most innovative companies on like the Forbes 100 list, that would be Amazon, Salesforce, or today, look at Tesla. That is a really positive sign. And that is where a whole bunch of outperformance comes from when you buy something today, and then in a year or two, that company launches a whole new product or service that was unaccounted for, that the market suddenly has to value. That's where a ton of outperformance comes from. So that's a second criteria that I look at. And if you force me to say a third, I would say the management team. I generally want to see founder-run businesses with great ratings from employees, a mission-driven culture, and high inside ownership. I think those three things together put the odds of success on your side.
Yeah, definitely. And, as you said, they're all on your checklist, and they are so important when analyzing a company and how they're performing. And you mentioned Tesla there, and I guess it's an interesting company because I think it's one of your best performing investments from what I saw. I think it's, 10,000% increase or something like that. Do you see, and this is just my opinion, do you see sort of Tesla becoming maybe similar to an Apple, where it's going to just build these massive network effects? I think they're talking about launching a phone. They're talking about launching, obviously their solar panels, all these different things. Do you see it as like a similar to Apple, where it's a company that if you own a Tesla car, you're going to want to own everything else? Sorry, that's completely off what we've been talking about, but
Yeah, there's halo effects to the company's brands. I wouldn't say it's necessarily a one-to-one with the likes of Apple. What's made Apple so incredibly successful is if you have an iPhone, it works seamlessly with your iPad, with your Apple Watch, with your Apple Mac, and they've created an ecosystem amongst their products that tie them together. I mean, I myself probably have 15 Apple products in my house, and the odds of me buying something else, some other brand in the future, are very, very low. I'm in the ecosystem, and it makes no sense for me to do so. Whether or not Tesla can do that same thing, I don't know. I mean, if you look at what they're working on today, they pretty much have the Model 3, the Model Y. That is the lion's share of revenue growth. They also have the solar panels and the energy storage. They've also announced things like the Tesla bot, as well as full self-driving. So whether or not those products complement each other and work together, I could see some of that happening. I doubt it would be as strong as Apple could be, but I would love to be positively surprised on that front. So could it happen? Sure.
Yeah, definitely. So sorry, that was just just out of the blue question. If we go, because obviously from looking at your analysis, it's all very much based on maybe a bottom up approach, looking at the actual company and the not really looking at the external aspects of it. So I guess do you take anything into account to do with the global macroeconomic effects and trends that are happening throughout the world, or are you mainly just looking at these strong companies?
So the macro matters a whole bunch, right? There's no doubt about that. What's happening with the Fed, what's happening with interest rates, what's happening with economy, with unemployment, all that stuff matters tremendously in the short term and has a huge impact on stock prices, stock valuations, the mood of the market, etc. I just know for myself that it's very easy to look at any given data, any given metric that you see out there and draw conclusions from that, like, oh, interest rates are going to do blank, therefore fill in the blank for stocks, bonds, gold, mutual. You could create any story that you want. And I know myself that I have been wrong many times when trying to make macro calls. I mean, if you rewind the clock to 2008 and 9, for example, back when the national debt was surging, that time the national debt of the United States was surging. That time there were calls everywhere for inflation to skyrocket over the next 10 years, and all the data in the world made complete sense and supported that argument. And you would be foolish to think that anything else could possibly happen. And yet, if you look at what actually happened, the 2010s were some of the lowest inflation rate numbers on record, like on record. Now, conversely, now we've seen inflation finally start to rear its ugly head. So does that mean that there was a 10-year delay between the last one, or is that 100% caused by COVID, or is that all caused by the supply chain challenges? And once the supply chain challenges get solved, does that mean inflation's going to die? The answer there is I don't know. There's no way for me to accurately predict that. I think that's just incredibly hard to do. So rather than try and think about that from my perspective, I try and neutralize all that by continually buying, right? I'm personally a perpetual buyer of stocks in the stock market. And two, by focusing on a bottoms-up approach to investing. If I find a company today that is doing $10 million in revenue, and in 10 years, that company is doing $500 million in revenue, the odds of me having a very positive outcome with my investment are extraordinarily high, no matter what is happening with interest rates, the stock market, the Federal Reserve, et cetera. So in the long term, all that macro stuff tends to wash out. And what really matters to the investments that I make is what happens to the performance of the business. So for that reason, I largely ignore the impacts of the macro and instead focusing on the individual companies themselves and whether or not I think they can succeed.
And I think that's quite similar to Warren Buffett's approach, isn't it? That, if you look at the past 50 years, stocks have gone up, they've gone down here and there due to macro effects, but they've normally gone up. So I guess, is that sort of your influence for that?
Oh yeah, completely. I mean, if you look at it's such a great case study what happened with Buffett and Berkshire Hathaway. Berkshire Hathaway is one of the most stable, reliable, diversified, well-run businesses on the face of the earth that will ever exist. And yet, if you look at the history of Berkshire Hathaway's stock peak to trough has fallen more than 50% 4 times. Peak to trough, 50% more than 4 times. And that includes during the the run-up of the dot-com. The day that Berkshire Hathaway hit a new low, the NASDAQ hit a new high. And so Warren Buffett's stock was in a bear market at the same time that the NASDAQ was in an insane bull market. And he said numerous times in his writings that I wouldn't change anything based on doing, even if the Fed chief was whispering in my ear. And I don't think that anybody can successfully time the market. So if he's saying that, what chance do I have?
Yeah, definitely. And he's proven it successfully. And there's that classic chart recently. I think it's the Cathie Woods versus the Berkshire Hathaway, and they've just really diverged on each other over the past few months, even though, Cathie Woods went up massively and now it's come back down. So I guess, as you said, over the long term, it's quite consistent.
Yeah. What's interesting about that chart that people reference is that typically from the start of the 2000, right? And if you look, Cathie Woods' ARK fund is crashed in recent months, and Berkshire Hathaway has soared. However, I will point out, if you zoom out that chart, ARK is still crushing Berkshire Hathaway stock by more than 140 percentage points since inception. However, there's no doubt that the investors that poured into the ARK fund got in 2020 and 2021. Like, that's when they had massive inflows, and so many of those investors are way underwater right now, given what's happened. But personally, I'm a fan of Cathie Wood's strategy, so I would bet by 2025 her lead is going to increase. But hey, we'll see.
Yeah, we will. And I think there's that classic thing that, for the people who get into the ETFs first, they really benefit the most. And the people who get in obviously later, once they've had the high performance, they're not going to benefit as much. But then it's probably going to be the same now, as, we're getting to a low, people who come in now will benefit. And then anyone who comes in later might, not as well.
Yeah. So there was a study done, and I don't have the data in front of me, but Peter Lynch's run as the manager of the Magellan Fund between, I think it was 1970 something to 1990 something. He ended up compounding his shareholder wealth by over 20% per year during this huge stretch. And yet what they found was they did analysis of the fund inflows and outflows is the exact same thing that's happening with the ARK today, right? He would have a great year, a great quarter. He would get tons of money, and then his investing style would go out and people would pull their money out. So what the investment does, right? What the fund does and the actual returns that investors get can vary wildly. Why? Human behavior.
Yeah, definitely. And that links perfectly to my next question. So I was just going to say the past few months, we've seen large downsides for many of the best performing growth stocks. And then I guess, how do you prevent yourself from panicking during these volatile times? Is it just that writing it down and running your plan down and understanding that you're investing for the long term, or is there anything else that you do to help yourself?
Yeah, so that's by far the most challenging part of investing, right? Is the game that you play in between your two ears, saying woulda, coulda, shoulda. Things are always obvious in hindsight, and saying that you have the ability to withstand volatility and actually having the ability to withstand volatility are just two completely different things. It's so easy to look back at the historic returns of the S&P 500 and say the tech crash looks bad. It wasn't that bad, right? Oh, 2008, look at the great buying opportunity that it was. When you're living through those periods day by day, hour by hour, minute by minute, and you're seeing the news and people losing their jobs and your stock prices are falling, it is very hard. Very, very challenging to stick to your long-term plan. But the way that I do it, there's a couple of tricks that I use for myself. First, be part of great communities of people, of long-term investors. So thanks to the Motley Fool, thanks to Twitter, thanks to Microcap Club, et cetera. There are all these great communities out there of long-term investors that just live and breathe this stuff. And downturns don't hurt them as much as they hurt the general public. Two, study market history. Study market history, and you'll find that every downturn that's ever happened has always been a buying opportunity, even though whenever they happen, people are always freaking out. And if you look back at the long-term performance of the greatest stocks of all time, every single one has been murdered at some point, falling peak to trough 50, 60, 70, 80, even 90%. That is just par for the course. If you're going to be investing in the markets, you have to, full stop, have to accept that huge occasional drawdowns are the price of admission. And then lastly, I've trained myself to focus on the business performance, and do my best to ignore the stock performance. And in fact, if a stock is going down while the business is executing and going up, that can be a great buying opportunity. If a stock is going down and the business is going down, that is a big warning sign, right? So I've trained myself to focus on the business, not the stock, which is, again, easy to say, hard to do.
Yeah, and I guess you can link that to maybe an example at the moment is Peloton, where the business has been going down drastically, and we've seen the stock price drastically go down as well.
Yeah, exactly. So Peloton, the stock is down huge from its all-time high. But if you look at what's happening with that company, they're laying off people. They just canceled a factory, right? Revenue is trending in the wrong direction. But if you look under the hood, the brand name still seems to be okay. So there is a business there. But so much of their demand got pulled forward over the next 3 years into 2020. And given their business model, which is selling expensive equipment one time, which drives the lion's share of their revenue, their year-over-year numbers are going to look very, very bad for a while. So Peloton is a stock that I personally got wrong. We made a video about it saying that we like this company. It checks a lot of the boxes for us, but wow, were we wrong on that one.
Yeah, I was the same as well. And I was just lucky that I got out reasonably early. So we were talking a lot about these great companies, and potentially a lot of them are growth stocks or they're just, good companies in general. How do you incorporate them into maybe your portfolio allocation diversification? Does it factor into your framework, or how does that work?
So when it comes to buying and building a portfolio, I don't think there's any necessarily right or wrong way to do it. I just think it depends on that every investor needs to answer this question for themselves and develop a strategy that works for them. One simple question is, how concentrated of an investor do you want to be? If you're new starting out, I would say don't go for concentration, because it's really easy to make mistakes and cost yourself huge amounts. Conversely, I know some investors that would be happy to have 70% of their portfolio in one company, so long as they knew that company really well and had huge belief in it. So when I think about diversification and portfolio building, I think of it as a sliding scale. If let's say I did analysis on Microsoft And I was like, I think Microsoft is a fantastic business. It's just executing so well. It's going to be a market beater from here. Well, Microsoft, the business, is very low risk. It's growing. It's fantastic. It's just a phenomenal company. So if I was to build a position in that company from scratch, I would have no problem buying that one slightly more aggressively than I would a small cap stock that is in the unknown. Maybe it doesn't have revenue yet. Maybe it's developing something. Maybe it's not making money. So I would approach those two differently. But broadly speaking, my strategy is I tend to favor smaller companies, so companies under $50 billion. I like to look for companies that I think have a long growth trajectory, that are profitable or on the cusp of becoming profitable. And if I'm right about the business, I could see myself earning a 10x return. But those businesses tend to be higher risk. So the way I approach them is I put very small amounts of my portfolio into them continually. So I like to buy in 0.5% increments, so half of 1%. And I try and buy the same companies again and again and again at different valuations over time, always trying to pay a lower and lower valuation for the stock. Notice I said valuation, not price. Those two things are independent of each other. If I'm right about a company and I buy a little bit and it starts to grow, once it reaches 3% of my portfolio, I stop buying it and I focus on something else. So if a company becomes if that company continues to win and win and win and continues going up and up, my whole portfolio gets lifted up with it. But I like capping my personal risk at 3%. Now, my largest position today is Tesla. Tesla is about 10% of my portfolio, not because I set out for it to be 10%, but because it's gone up so much that it's become one of my larger positions. And the same is true of all my biggest positions. I was just right about the business, and their stocks have flourished. This strategy has downsides. The biggest downside is if I'm right, I make less money. But the upside is if I'm wrong, I don't lose that much money. And what's so wonderful about investing is it's asymmetrical, right? If you put $100 into a company, you can make $10,000, $100,000 if that company is a true mega winner. Put $100 into a company, the most you can lose is $100, right? So it's an asymmetrical risk reward, and because of that, I'm comfortable with my current strategy of going slow and buying into companies slowly. But that's not the right fit for everybody.
Yeah, and it's about figuring out what's best for you and what you want to do. And I guess at the moment we're seeing many of these massive new industry trends coming through, and with massive potential, digital payments, virtual reality, or I think you made a video about this as well. 10 different trends to watch out for. I think there was autonomous vehicles and maybe healthcare as well. How would you balance maybe jumping into these really exciting opportunities, but actually finding a company that because if it's not going to happen for the next 10 years, how do you find those companies that you might be winners?
So when it comes to trends, one mental model that I like is I like to think through the value chain. So could be a confusing topic, but some trends, some industries have extremely good economics for the players in them. And when a trend comes along, the companies that have dominant market shares in them do extraordinarily well as stocks. Conversely, some mega trends, the economics, actually the value that's created from the trend, don't go to the companies that are taking part of the trend. They actually get captured by other means. So let's take a quick example. Software and cloud computing is probably one of the best economic trends that investors have ever seen. If you get a software company that continually adds customers, continually upsells those customers, those companies tend to have highly predictable revenue, strong margins, high switching costs, and incredible long-term ability to generate predictable revenue and translate it into profit. There are so many winners in the software space that you like. It's been a wonderful fishing ground for investors. Conversely, if you look at the solar industry and think through that, the number of solar panels that we are making and consuming today dwarfs what we were doing in 2008 and 2006, back when the industry was in its infancy. So if you look at that, you're like, wow, I don't know the numbers, but let's just say $1 million worth of solar panels were sold in 2006. Today, it's like billions of dollars of solar panels. Like, the growth has been huge. Solar panel makers must be killing it right? They just must be doing fantastic. And actually, the answer there is no, no, they've been terrible investments. Why is that? Solar panels grow adoption by continually lowering prices, right? All of the benefits that are created by investing in R&D and making solar panels more efficient and cheaper, all that value goes to the consumers of solar panels, the buyers of solar panels. So solar panel manufacturers are in a never-ending race to lower prices, lower prices, lower prices, and that caps their margins. So while their volumes are increasing tremendously, the amount of profits that they get to keep has been under check and is actually very volatile. So the solar industry, for example, is an example of a mega trend where the value that's created by the industry is going to be captured by society and consumers. So when I'm thinking about mega trends and what trends I got to go through, one of the exercises I like to do is I ask myself, well, okay, this thing is going to create value. Who captures it? Is it likely to be the companies? If so, which ones? Is it likely to be society, consumers, the environment, other things? If so, I'm going to try and avoid those.
Yeah, and I guess that's where, you link back to your framework. That's the moat. These companies don't have any moat at all protecting them from, from other competitors.
Yeah, right. Well, they might have. That's the interesting thing about moats. So if you were to take a company like First Solar, I think it does have a moat in terms of scale, production, brand, relationships, et cetera. But that moat is only useful if you can translate that into continued growth in gross profit and maintain pricing power. So that's why you can't ever just focus on one metric or one thing and say, oh, this is going to be great. I mean, look at utilities, right? Utilities have unbreakable moats, right? They have monopolies in local geographies, and they have guaranteed revenue, and yet historically utilities have been places to store wealth, not really grow your wealth, because they're so heavily regulated and their prices are controlled by local agencies. So again, but as far as moats goes, it doesn't get any bigger.
Yeah, definitely. And we'll go to the, we only got a few more questions yet left, but thanks for your time. We'll go to maybe the health tech industry, and that's something that, you started your career in health tech. And, does your framework, is it the same for these types of company, or do you change it just based on the actual industry and how it works? Because, obviously these pharmaceutical and health companies are completely different to many other companies.
Yeah, so no framework. In my experience, my framework does very well for some types of businesses, some types of industries. Technology industries, it does well. Healthcare industries, it does well. Consumer good companies, it does well. Durable goods, it does well, etc. There are some industries where it falls apart completely, and that's just the nature of the industry. In the insurance industry, it does not do well. The banking industry, it does not do well. The biotechnology industry, it does not do well. But I'm okay with that, because those industries are just not the type of investments that I am interested in. But you could easily adapt the checklist or create a different checklist that catered to the needs of any specific industry. So again, this checklist isn't the be all end all perfect thing for every investor in every situation. What it is the best framework that I've developed so far for finding companies that match my investing style. But companies that score very poorly on my checklist have gone on to do great. Companies that score very well on my checklist have gone on to do horrifically poor. So it's not perfect by any means and could be adapted depending on what you're looking for.
Yeah, perfect. Great advice. So, Brian, thank you so much for joining the podcast to talk with me today. And, just on to my last question, what is one message that you'd like listeners to take away from our interview?
My message would be think long term. Think long term. It is so easy to say that, so easy to say, yes, I'm a long-term investor. It is so hard and actually quite rare to find people that truly think on long-term time horizons. But if you zoom out, if you continually just take one lens wider out on your life, on a trend, on a company, on a business, it allows you to see things so much more clearly. And it's just human nature to get bogged down by minutia and the news of the day and things like that. So my message to the world is just think long term.
Yeah, definitely. That's a great message. So, Brian, thanks again. I mentioned that you're releasing a book coming up, so I don't know if you want to talk about that, and then where else can people find, content that you release?
The best way to find me is either on Twitter, I'm at Brian Feroldi, or on YouTube if stock analysis interests you, and that's Brian Feroldi YT for YouTube. But yeah, my big project that I have coming out later this year is my book called Why Does the Stock Market Go Up? That should be available retailers globally, although we're still working on all the countries and international rules. But you can pre-order it today on Amazon, and the title of the book is Why Does the Stock Market Go Up? It's not about stock picking. It's not about individual stock analysis. It is solely designed for people that are brand new to the stock market and explaining the history of the stock market and that all important question, which stumped me, which is why does it go up over time?
Perfect. I guess the stock analysis will be the second book, will it?
Maybe. I don't know. Writing a book is really painful. So I need some time off if I write a second one.
Yeah, I can imagine. Relax somewhere. So, Brian, thanks again for your time.
Anthony, thanks so much for having me.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.